Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is John Darby, founder and CEO of Astoria Portfolio Advisors. Astoria is an investment management firm that specializes in ETF managed portfolios. John, welcome and thanks for joining us.
Thank you very much for having me.
So tell us a little bit about your background and about Astoria.
Sure. So Astoria is an investment management firm that uses ETFs to build solutions on behalf of our partner clients. We typically interact with financial planners, small RIAs, people that are looking to outsource the investment management component of their practice. So we would handle like the portfolio construction process, the trade-in, the execution, the research. So we look at us as like an outsourced CIO firm. Mm-hmm. The firm's been around for 2.5 years. I've spent about 20 years on Wall Street. Prior to starting Astoria, I was the head of ETF content at Morgan Stanley. I sat on the ETF trading desk. Mm-hmm. For 18 years, I dealt with institutional investors, and now I'm in the RIA kind of wealth management world. So the idea is that I take the institutional experience that, not only myself, but my partners, and, we build these solutions for other RIAs.
Okay, very interesting. So Astoria has created a model portfolio, and you have 10 ETF picks for 2020. And before we discuss your picks, I would love to get your perspective on the market in general. And 2019 was a banner year for stocks. The S&P 500 was up about 29%, the Dow was up about 23%, and the Nasdaq was the big winner with a gain of over 35%. And in fact, it was the best year for stocks since 2013. So what is your stock market outlook for 2020? Can the rally continue?
I think it can, and what I would say is that the tagline that we have for our year ahead report is that the tagline is literally forget the past decade, invest with a forward-looking strategic vision. So, I think investors are just enamored with what's worked in the past, and they think that it will continue in the future, right? So, if you talk to most big capital allocators, they'll talk to you that they still want private equity, venture capital, real estate, U.S. growth, right, tech stocks. And, I just think that because capital is looking to get allocated, looking for the highest return per unit of risk, mm-hmm. Generally speaking, people will rotate because the next big winner is by definition per unit of risk shouldn't be what's worked in the past. Mm-hmm. So, we have this tilt in the portfolio towards international markets, emerging markets in particular, China in particular. We have some exposures to U.S. value stocks. So, as you and I talked about, before this podcast, in order for you to outperform the benchmark, you've got to do something different than the benchmark. Mm-hmm. So what that translates for us is a lot of, ETFs that are different from just buying, VTI or VOO, or SPY, right? Mm-hmm. That is the benchmark by definition, so you've got to do something different than, if you want to try and outperform. So before I go kind of further into that, I'll just say a couple things. Mm-hmm. In terms of how we build solutions and how we build portfolios, there's a couple principles that we believe in. Mm-hmm. First is that you want to diversify your factor exposure. So you want to own value, momentum, quality, kind of yield, the size. You want to have a portfolio of factors because the research shows you can get higher beneficient frontier if you harvest a portfolio of factors. Second, we believe in alternatives, and I'm not talking about 25% of the portfolio, but, a small, modest amount. And if you include alternatives, ones that work, it'll mitigate some of the downside risk. So it kind of helps your risk-adjusted returns. And we as a firm believe in after-tax risk-adjusted after inflation returns. And those are three key things that I don't think people tend to focus on.
Mm-hmm.
They tend to either just want, absolute returns, not risk-adjusted. They don't believe in inflation or after inflation returns, and they don't do things to the portfolio like tax loss harvest, which is something that we do. So a couple of things that we do to the portfolio, underweight bonds. We just think that right now, yields where they are, it's not an overly attractive risk return, the fixed income marketplace. I do think inflation on the margin is ticking higher, so, I think bonds will struggle with that.
Mm-hmm.
I mentioned this overweight to rest of the world, international markets, underweight in the U.S., largely speaking, underweight in growth, overweight in value. I think those are things that we do to the portfolio. So what we told people in our year ahead report is, the U.S. 60-40 stock bond portfolio has had astronomical returns in the past decade.
Yeah.
So, forget what's worked in the past, try and rotate to where the puck is going. So more like a 50-30-20 per se, if you previously had a 60-40, just because bonds won't do and U.S. stocks won't deliver the returns that they used to.
Okay. So talking a little bit about the past winners, tech stocks, the tech sector actually surged about 50% last year, and energy was the only sector with a single-digit gain, and communications services sector, which was carved out of technology, was the second best performer with a gain of about 31%. And that has been the trend, during the past decade too. Growth-oriented sectors and growth stocks have significantly outperformed their value peers, except maybe in 2016, because investors have just been chasing growth at any price. But you favor value stocks for 2020. So do you think value can make a comeback after lagging growth for so long?
Yeah, and I should just clarify that we run global, diversified, cross-asset portfolios. So typically, our benchmark would be, let's just say 60% MCHI ACWI, 40% Bloomberg, Barclays Ag Bond Index. So, we try and have exposure to a lot of different areas because, our goal is to not... I think some ETF strategists in the past, what they did was that if their benchmark was 60-40, they would maybe go 70% equity, 75%, and try and outperform just by having greater equity exposure. And I think that can work 1 year, but it's not like a repeatable, systematic, strategy. So if our benchmark is 60-40, we're going to have, a couple hundred basis points plus or minus at the equity level, and try and outperform by using ETFs that have higher active share, higher concentration risk. Like for emerging markets, we may have like EDIV, let's say, as our core EM position, and we can explain what that is afterwards. That's the emerging market dividend grower ETFs. So that's how we try and outperform. So U.S. value is, if you break down the 60-40, there is a allocation that you're supposed to have to it. So for U.S. value, we like banks in particular. We'll use something like KBWB for a bank exposure. We'll use the IVE or QVAL value ETF to get our U.S. exposure. But I do think you want to tilt towards that. Big picture, as we keep talking about, the last 10 years, what's worked. Any asset sensitive to quantitative easing, low interest rates, so that would be stocks, bonds, real estate, anything that benefited from low inflation, low interest rates, really benefited. And growth stocks, think about it, right? Longer duration strategies, the FANG stocks, as you mentioned, tech was up quite a bit the last year or two. The U.S. stock bond portfolio, as I mentioned, has had, really significant compound annual growth rate the last decade. So I just don't think that it's going to repeat. So what that translates into is, something like U.S. value stocks, which have largely underperformed, that is an area that I think is attractive per unit of risk, in the next 10 years. So that is a secular trend that we have in the portfolio that we're hoping to capitalize on.
Okay, great.
But that is just one component of a broad, diversified global portfolio of 10 to 12 ETFs that we have.
Okay. So among your picks, as you mentioned, is QVAL, which is Alpha Architects U.S. quantitative value ETF. Could you tell us a little bit about this ETF? And another pick is by WisdomTree. It's WisdomTree US Mid Cap Dividend Fund with the ticker symbol DON. Why mid cap?
Well, mid cap is it's more idiosyncratic compared to, let's say, large caps or small caps.
Mm-hmm.
Large caps, I think, carry globalization, dollar risk. Small caps carry credit, funding risk. Mid caps are kind of in that sweet spot. And if you look since 1996, the mid cap ETF MDY has actually outperformed SPY by about 200 basis points on a compound annual growth basis. So it's got higher returns, higher Sharpe ratio. Mm-hmm. So DON is a $4 billion ETF. It's big. It's liquid. It is a form of active management in the sense that it does pick higher dividend yield than mid cap stocks. But as I said, in order to beat the benchmark, you've got to do something different than the benchmark. So MDY has like an 18 PE ratio. DON has a 14.5 PE ratio. It's got higher payout ratios, higher ROE. Mm-hmm. So it's just a higher quality, kind of value play for mid-cap stocks. So it's one of our picks. It's one of the ETFs we have in our U.S. thematic portfolio. So we like that quite a bit. And the QVAL is just U.S. large cap value stocks. Actually, sorry, it's U.S. value stocks that has a couple of quantitative filters. One of being value as defined by enterprise value over EBITDA, mm-hmm. and then the other is they have a quality filter in there, and then they weight the portfolio on an equal weighted basis. So if you load it up into a risk model, you wind up getting exposure to value, quality, and the size factor. So it's kind of a nice ETF if you're trying to get exposure to a couple of different risk factors, and it's also 50 stocks, so it's got some concentration risk, which we like. I mean, we don't say to put 25% of it in the portfolio. It's whatever the benchmark allocation is to value stocks, and we may tilt that 100 basis points above or below. And in fairness, we do split our value exposure between that and the IVE, depending on the model. So.
Okay, yeah, it's a very interesting ETF. I agree with you on that. Now let's talk about bond ETFs a little bit. They were very popular last year, saw a lot of inflows, but they do look a little bit expensive now. And you also mentioned that you're not very positive on fixed income for 2020. Tell us a little bit more.
Well, I mean, we've been bond bears for several years now. Mm-hmm. I know money keeps going into bonds, and there's demographic reasons for why. Baby boomers retiring, Taiwanese life insurers need income, and Japanese, life insurers need income. So a lot of them are just keep bidding the price up of bonds. So if you think about bonds historically, what they would have done is they would have provided you hedging solution. So when stocks go down, bonds go up. And they still do some parts of it, but that's during extreme kind of sell-offs, I would say. You get that inverse correlation. Second thing that they historically provided was income, and we know that they don't really give you much income. Right. And the third element is this element of carry. And, I just think that when you put, $3 trillion into bonds over a 10-year period, you're going to arbitrage a lot of those risk characteristics out. So, what we do is, and I should have said this in the beginning, but we have a series of dynamic strategies and a series of strategic. And our dynamic ones are the ones we're talking about, where we have things like QVAL, DON, before our strategic models, which are, tighter tracking error, let's say, we use 50% low-cost ETFs and 50%, higher manager fees, a little bit more tilts. And, for our dynamic strategies, we don't have any core U.S. aggregate bond ETFs. We try and replicate these three characteristics I mentioned, which is hedging, carry, and income. We try and reverse engineer those risk characteristics by just having outright positions in things like munis, agency mortgage-backed securities, short duration, ultra duration bond ETFs. So we wouldn't have a position like AGG or BND or some of these active managed strategies like AGGY or JAG from JP Morgan. We don't use them in our dynamic because we try and reverse engineer it ourselves. And our strategic models, which are, as I mentioned, designed to be lower track and era, for those, we would have like an outright position in, one of the core aggregate bond ETFs, like the AGG or the SPAB, SPAV. But, we're going to underweight it because of our view that, bonds are rich and, I think inflation on the margin, is ticking higher. So we don't have a lot of good things to say. That's the irony of this bull market is that, bonds are expensive. I think most real estate is expensive. Private equity is expensive. Venture capital is expensive. But, stocks still per unit of risk, I think, are still attractive. And, the more attractive they are is, the more overseas you go, the more attractive it gets, to be honest. So.
Okay. So let's talk about international market because you mentioned going overseas. Now, the trend which we have seen in the past decade is that U.S. stocks continue to outperform, and particularly they significantly outperform the emerging markets. You are positive on international markets, developed as well as more on emerging markets. Now, let's first talk about the international developed markets. And you have another WisdomTree ETF pick over there. That's the WisdomTree International Hedged Quality Dividend Growth Fund with the ticker symbol IHDG. So why international stocks and why did you use a hedged ETF for this? Do you expect the dollar strength to continue?
Well, I mean, let me start with the ETF and then we'll give it a rationale. So IHDG is a blend of high-quality stocks plus stocks that grow their earnings. So it's the equivalent of DGRW, which is a fairly big ETF. I believe it's a couple $2 billion. And DGRW is our top hold in our dynamic, portfolios. So this is the equivalent of that, but overseas. So the goal here is to screen for companies that have above average ROE, ROA, low kind of financial leverage. But along with that, companies that have, above average earnings growth. So it's a 50% quality screen, 50% earnings growth screen. It did very well last year. Part of that is because it has, concentrated portfolio. It's about 300 stocks. EFA has whatever it is, 1,200 stocks in there. So again, to the point, you've got to do something different, from the benchmark if you're trying to outperform the benchmark. So it did well, and shockingly, it outperformed EFA by 12%. And it even outperformed the S&P 500 by a couple hundred basis points. So currency is a big driver of it. As you mentioned, it's currency hedged. I just don't think that, like, for currency, long-term expected returns for the euro are flat, marginally up. I just don't see why you want to own an asset, let's say, that doesn't provide high expected returns that come with volatility. The textbooks would say, or risk model would say, you might as well hedge out the FX risk if you're going to own an asset that doesn't deliver you returns but comes with volatility. Okay. I've been working for over 20 years. I've never found anyone to make good, consistent calls on the dollar, oil, or gold, right? So I just think, you want to hedge out the FX risk. So we had a call early in the year to buy international markets, buy emerging markets. They're cheap, but they've been cheap for a while. But the catalyst, in my opinion, is two things. One is, China keeps injecting liquidity, massive amounts. So I think that's a positive for, we've been in this liquidity-induced rally the last 10 years. So I think the catalyst for Europe is ECB when they pivoted and said that, that they were going to restart their quantitative easing program. That obviously was a big pivot. So, we've made this allocation shift. And then, obviously, when the Fed did their pivot, you could argue that the Fed pivoted January of 2019, and then they obviously signaled in September of last year that they were going to cut interest rates. So just we're living in this ocean of liquidity right now, and I just think that you've got higher risk in the U.S. compared to overseas.
Okay. Now let's talk about the emerging market stocks. And as I mentioned, emerging market stocks have significantly underperformed U.S. stocks over the past decade. And one of the reasons was dollar strengthened about 23% against the basket of other currencies. And emerging markets stocks, they are usually inversely correlated with the dollar. But now you're very positive on emerging markets, particularly China. And you have two ETF picks among 10. One is Spider S&P Emerging Market Dividend ETF with ticker symbol EDIV. And then you have a China ETF, iShares MSCI China ETF, ticker symbol MCHI. And EDIV is also about 24% China. And we have seen a nice rebound in Chinese stocks since December. That is thanks to trade optimism, and also because the Chinese central bank has been injecting a lot of liquidity, as you mentioned. So tell us a little bit about your outlook for emerging markets, China in particular, and these two ETFs.
Sure. So, going with the theme that we've been saying, how if you're trying to beat the benchmark, you've got to do something different than the benchmark. If the benchmark is EEM, how are you going to outperform it, right? You've either got to have a higher position in EEM compared to its benchmark weight, or you got to own an ETF that's constructed differently from EEM. So, and again, like our goal is to deliver after-tax, more attractive risk-adjusted returns, inflation adjusted. So EDIV is just a tight basket of 100 stocks. EEM, I think, is 1,000. It's quantitatively constructive. The criteria is systematic in nature in terms of how they screen for companies that have higher dividends. There's certain specific earnings ratios that they apply, when they rebalance the stocks. So we like that quite a bit. There is some tracking. It is EM value stocks, no doubt. Okay, it is EM value play for sure. Now, one can argue that EM in general has a lot of value kind of plays inherently in it. But what we do is we hedge the EDIV with just an outright position in MCHI, China. So look, in our perspective, for EM to work, China has to work. Okay,
right.
Unless you're going to go out and trade Mexican home builders or Brazilian malls, and that's just a very small piece of like individual countries. I mean, you can't really build a portfolio with Mexican home builders, let's say. But for China, you're either going to trade, the broad basket, or you're going to buy like the internet stocks or the Chinese tech stocks. And I just think that given that we have this outright position in EDIV, we're hedging that value play by buying MCHI. MCHI is just broad, large, mid-cap stocks. It's B shares, H shares, some of the red chips, the B chips. It's got some large cap A shares in there. The bottom line is that there is some concentration. There's a couple of stocks that are at the top of the basket, but I think China's. If you look at the earnings per share growth for that MCHI, it's about 20%. U.S. is something like 7-8% earnings per share growth based on consensus 2020 numbers. MCHI is like a 14-15 PE. S&P is about 20. And, as you mentioned, that China and EM has dramatically underperformed the U.S., right, the last 10 years. So it's a tilt in a portfolio. I think it's attractive. And, I think, keeping with this idea of, like, the next 10 years, these cycles go like 5-10 years, like U.S. over the rest of the world, EM over U.S. So if you're a capital allocator and you've got billions of dollars to invest, are you going to buy large cap growth that's already outperformed the last 10 years? You're probably going to look somewhere differently. So
okay, makes sense. Now let's talk about gold. Gold has also done pretty well of late. It passed $1,600 per ounce recently, thanks to Iran tensions. It has come down a little bit since then. And I usually recommend that investors should have about 5 to 7% allocation to gold in their portfolio, mainly due to its low correlation with all other major asset classes. You have a gold miners ETF among your picks. It's by VanEck Vectors, ticker symbol GDX. It's actually the largest gold miners ETF. So tell us about your outlook for gold and why gold miners instead of gold.
Well, I would say that the goal is to deliver, attractive, risk-adjusted, after inflation, after-tax returns, right? So gold is inversely correlated with stocks. You've kind of seen that this past 10 years, right? S&P up, 400%. Gold, I think, is up, 20, 30%. But, during periods of shock, gold has worked well throughout this cycle, and that's where that inverse correlation, comes into play. I just think that there's a place for gold in a portfolio. It softens the volatility. It tries to get us, tries to deliver one of those three things that I mentioned in terms of, risk-adjusted returns, higher Sharpe ratio. I think your opportunity cost for gold is fairly low, given that interest rates, still pretty low, and they're negative in certain countries. I think that I don't know when the recession will occur, but, gold has been rallying, it feels like, for the last 6 to 12 months. And, I just think investors are starting to realize that your opportunity cost is fairly low, and it's worth having because you can't time when the recession occurs. So we do have an outright gold bullion ETF position in our portfolio, and we had that in last year's top picks. We did have gold miners in the portfolio. We added that about a year ago, and so we just went with the gold miner ETF in our top picks. But we like both of them. I think gold miners are pretty cheap. It's higher beta to gold bullion itself.
Right.
And I agree with you in terms of the 5-7% allocation. We have less than that because we have other things we put in the portfolio that helps our downside volatility dampening. So, we'll have things like merger arbitrage, or we have this long-short market-neutral ETF in the portfolio to help try and mitigate the downside. And that is only in our dynamic portfolios, not in our strategic ones.
Okay. Now let's talk about other commodities too briefly. And other commodities are also usually inversely correlated to the dollar, and that is the reason why they did not do well last year, because of a strong dollar which weighed on commodities. And now if the dollar weakens a little bit or does not strengthen, and if we see a pickup in global growth, that may benefit other commodities as well, particularly industrial commodities like copper. And you have a commodity ETF among your picks. It's by Greenwich Shares. The ticker symbol is COMG. Tell us about this ETF and your outlook for commodities.
So commodities is, to hedge inflation risk, because as I said, we want to deliver after inflation, kind of returns. So, I think commodities are pretty cheap. Everyone hates them. COMB is a third allocated towards precious metals, a third allocated towards energy/oil, and a third towards agriculture. So, commodities are tough to time. I think you want to have just a broad-based basket of commodities. Some of the other big commodity ETFs, they'll have 50, 60% exposure towards energy and oil. And, there's no two-way, that means it's higher risk. So I like the third, because it's just a more kind of, spread out, diversified approach. But look, no one's talking about inflation. I think it's mispriced in the marketplace. Would not be surprised if, in the next 3 to 5 years or longer that you see better returns from commodities than you did in the past decade. This past decade for commodities was absolutely brutal.
Right.
And look, bottom line, CPI is at 2.3%, the highest since October 2018. So it's, it's something that, it creeps up on you, and I would not be surprised if it's a difficult year for bonds, and that commodities, on the whole, will do well.
Okay, that makes sense. Okay, and that's all we have time for today. John, thanks again for joining us.
Thank you. And for any further information, investors can go on our website, AstoriaAdvisors.com. All of our research is there, and obviously all the relevant disclaimers, because I mentioned a bunch of tickers that we own. Investors should look at that website for all the relevant disclaimers related to my presentation today.
Okay, thank you.
Thank you.
Thanks for listening. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.